Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to cover off a really spicy subject, real estate versus stock market. Which one should you invest in? When clients ask me, should I invest in the stock market or real estate? My answer is always the same. They just don't compare to one another. And there's a fundamental flaw in comparing these that I want to explain to you and then break down the fundamental numbers behind everything. So at the end of this video, I'm going to pair direct numbers of real estate versus stock markets. And I have a few different scenarios and examples to show you. Before we jump into it, if you haven't already subscribed to the channel, please subscribe to the channel. A lot of you are watching these videos, you're not part of our channel. Next week, we're gonna be launching a bunch of new videos around CPP, when to take it, taking it at 60, 65, 70, how it works, how to apply all that kind of stuff. As well, we're going through our personal finance series right now. So subscribe to the channel, get notifications on all the new videos that we post out, which are usually twice a week. Next week, we have 7 new videos coming out, so make sure you sign up for those. So what do I mean when there's a fundamental difference between comparing stocks versus real estate market? Let me explain. The one thing we never consider when we look at buying the two asset classes is leverage. So when we go to buy a stock, if I go to buy $100,000 worth of stock, I have the $100,000 on hand. Now, some of you might have a leveraged account, but that's few and far between. The majority of us are investing with cash that we have on hand. We're not borrowing money to buy the stocks we're investing in. We have that on hand. Whereas when we look at buying real estate, very rarely, and it probably doesn't make sense, but very rarely do we pay cash for a home. Okay, so if we're going to buy a $5,000 home, we're probably putting between 10 and 30% down. So let's say you put 20% down. So stocks, you bought $100,000 worth of stocks with your $100,000 cash. Now, when you look at real estate, your $100,000 is going to buy a $500,000 property. So there's leverage there. You're leveraging your money 5 times over. So when you compare the two assets, well, in stocks, you have a $100,000 asset still. With real estate, you're now at $500,000 asset. So common sense says this one, housing, should grow more over time. But I want to take a step back and talk about why are we so quick to jump into borrowing money to buy a house, but we don't borrow money to buy stocks. Now, before we get into it all, let me throw up a disclaimer. This is not a video saying you should borrow money to buy stocks. I'm just comparing the difference between stock investing and real estate investing. I don't think you should borrow money to buy stocks. We don't recommend it for clients. I've never recommended it to you before on any of our other videos, and I never will. I don't think borrowing money to buy stocks is a good thing. I just want to explain kind of the fundamental and psychological differences between stock investing and real estate investing. So let's jump back to the leverage concept. So again, if you had $100,000 and we're looking at buying stocks or real estate, at the end of the day, your $100,000 will buy you $100,000 of stocks. If you buy real estate, you can leverage that, up to 500, maybe even $1 million property. So leverage is huge, it's powerful, and it can help you grow a lot of wealth. Personally, we've bought a few houses I've mentioned on previous videos. We've had a mortgage on our properties. We've only put, 20, 30, whatever it is, percent down when we bought. And we've grown a lot of wealth through our real estate. So real estate investing for my wife and I, our family, it's been phenomenal. Outside of my business, it's been the greatest investment that we have. But again, I've leveraged that investment. So the amount of money I've actually put in, I've leveraged that to have good growth. Whereas if I took that money and put it in the stock market, how has that done? So I want to compare how has stocks done versus real estate. So this is a very hot topic. A lot of clients ask us about it. And I always say in general, stocks have done better, which people never believe. Especially since late 2013 into 2014, housing prices, Vancouver, Toronto, right across North America have skyrocketed. So let's break down the fundamental numbers of how real estate has done against stocks. So let's go back to March 1st, 1980. So Berkshire Hathaway stock in 1980 was $260 a share. Fast forward to today, that same stock would be worth $347,815, which is a crazy, crazy number. So over the 41 years, it's grown 133,675%, which is just mind-boggling. And that's why a lot of people, when they look back, that invested early on, there's stories, if you Google it on the internet, there's people that have made hundreds of millions of dollars off buying Berkshire Hathaway stock back in the 70s and 80s. So Google that, there's some crazy stories out there. Now, let's look at the average home price in the greater Vancouver area. So March 1st, 1980, the average price was $90,800. Now, shortly after this, I know a lot of you are going to say, yeah, but in 1981, the market crashed because interest rates climbed. Yeah, that's true. But leading up to March 1980, they also spiked quite a bit. So the number, the average is a pretty good average to take. You could go either way and it would come out roughly the same. So again, March 1st, 1980, the average house in Greater Vancouver area, $90,800. Today, it's worth $1,554. So that's an increase of 1,611%. Still a great growth, but when you compare it to Berkshire Hathaway stock, there's no comparison. So let's jump forward to July 1st, 1993. Why did I pick that date? Well, I picked that date because that's when the house that I currently live in was built. So let's go July 1st, 1993. Let's compare four things. Berkshire Hathaway stock was at $15,850. The average Greater Vancouver area home was $358,000. My home sold for $375,000 at that time. And I grabbed the TD Dividend Growth Mutual Fund. So I just wanted to kind of grab a popular average mutual fund that maybe a lot of you guys are invested in if you bank at TD and invest at TD. And we're going to put a $10,000 value. So if you invested $10,000 July 1st, 1993 in the TD Dividend Growth Fund. Fast forward to today, you can see the numbers up on the screen, 347 for Berkshire, average home cost 1.554. My home was worth about the same, about 1.5 million, and the TD Dividend Growth 94,757. So when you look at the 28-year growth, you can see stocks have done, Berkshire's done 2,094% growth. The TD fund has done 848% growth, okay? Real estate, just over 300%. So you can see that housing prices have actually lagged the market. And again, I just grabbed literally the first, bank dividend growth fund I could find that had a track record back to 1993. So I didn't pick and choose and whatever. Sure, there's going to be mutual funds that have done much better and some that have done much worse. I didn't put a lot of time into this other than grabbing, a bank dividend fund that had a long track record. So let's look at February 1st, 2013. So again, Berkshire Hathaway 145, average home in Greater Vancouver 901. My house sold, and I know this because the people we bought it off of bought it February 1st, 2013 for $700,000. And the TD Dividend Growth Fund was worth $59,021. So again, from that point, February 2013 to today, so that's when the housing prices really start to climb in Vancouver, Toronto, and right across North America. So we've had a big spike in housing prices. So how have houses the last 8 years compared to the stock market? And I know we're grabbing a Berkshire fund and a TD fund. It's not the whole market, but it gives you a good idea what's going on. So you can see there, the Berkshire Hathaway 8-year growth, 138%, still the leader. No one's beat it. TD Dividend Growth Fund is down to 61%, whereas home prices, my home has gone up 114%. The average has gone up 72%. So you can see there that it's pretty even, right? Like Berkshire outperformed, the TD fund underperformed a bit. My house has done quite well. The average has done fairly well. So when you average those out, they're actually fairly close. The market's probably done a little bit better than housing. So this is why I want to break this down. So often we're like, yeah, but houses are safe. And I think we feel they're safe because we maybe live in it, we can feel it, we can touch it. Whereas a stock is, it's probably on an app on your phone or the computer. You can't really feel and touch it, and it's hard to, monetize it and that kind of thing. So I get that. But sometimes we have to take a step back and look at the fundamentals of how stocks have done versus how housing is done. And they're actually pretty similar the past 8 years. When you break it out long term, The stock market has done better than the real estate market, at least in the greater Vancouver area. Toronto's going to be very similar, and I assume right across North America, right into the States, would be very similar as well. So, again, I want to take a step back to the leverage idea. If you have $100,000, you can buy a lot more asset if you go to the real estate side versus the stock market side. So keep that in mind. They're not apples to apples comparisons all the time. Again, we don't borrow money to buy stocks, we borrow money to buy housing. So is that a mindset that needs to be changed? I don't know. And I think a lot of cultures only buy homes with cash. And I think they've, learned, and I get it, housing prices are so crazy. Like, how could you buy in Greater Vancouver 1.55 million with cash? It's a lot of cash to have, I get that. And that's why we leverage it, and it makes sense. It helps grow wealth long term. So just wanted to break that down. So again, when you're comparing the two, you can't compare the two. They're very different types of investment. But when you break it down even further to look at the fundamental performance of both, again, in the last 8 years when we've seen the housing price spike, they're very similar. And when you look at long term, housing has lagged the stock market. So just be aware of that. So when you're looking to invest, if you have $100,000, you're not sure if you're going to go stocks or real estate, just take a step back and just understand that it's probably not a fair comparison to compare future growth based on the asset, because you're probably going to leverage the house. Thanks so much for joining us today. Hopefully this all made sense. Hopefully kind of broke down why real estate we view as doing better, but also, why are we so quick to jump into leveraging money and borrowing money for real estate when the markets have actually done better? And again, I'm not saying go out there and borrow money to invest in stocks. Don't do that. I do not recommend that. But just have a different mindset maybe around how we invest in real estate versus stocks, and how both are different asset classes and how they work differently from each other. So thanks so much for joining us today. All the best in either your real estate investing or your stock investing. We hope you're having great success with that. And thanks so much for joining us. Again, if you haven't subscribed to the channel, please do so. And if you enjoy these videos, hit the thumbs up. It really does help get our videos out to more people. Thanks. Have a great day.